Welcome back to the COO's office. We have spent the last few sessions dissecting individual companies. We looked at their value chain, their competitors, and their financial health. You now know how to pick a good athlete. But today, we need to look at the stadium they are running in. Because even the fastest runner cannot run fast if the wind is blowing against them at 100 miles per hour. Today, we tackle the oldest and most intense debate in the history of investing. Growth stocks versus value stocks. Which one is better? When should you buy? Which beginners often pick a side like it is a religion. Some say I only buy innovation, others say I only buy bargains. As a coup, I tell you, do not be a fanatic. Be a strategist. To understand this, we must first define our two contenders clearly. In the left corner, we have the growth stock. Think of this as a startup or a tech giant expanding into new frontiers. These companies are selling you a dream of the future. They often have high revenue growth, 20%, 30%, or even 50% per year. But they might not be making any profit yet, or they reinvest every single dollar they make back into the business. When you buy a growth stock, you are paying a high price today for the promise of massive cash flows 10 years from now. Examples include companies in AI, biotech, or revolutionary software. They are the Ferraris, fast, exciting, but expensive and fragile. In the right corner, we have the value stock. Think of banks, energy companies, or consumer staples like Coca-Cola or Walmart. These companies are mature. They are not doubling their size every year. They might grow slowly, maybe 2% or 5%, but they are cash machines. They are profitable right now. They are often cheap compared to their earnings, and importantly, they often pay you to own them through dividends. These are the heavy-duty trucks. They aren't flashy, but they can carry a heavy load through a storm. So, the question is, when do you drive the Ferrari and when do you drive the truck? The answer lies in one single, powerful variable: interest rates. You must understand the relationship between money and time. When interest rates are low near 0%, money is cheap. It costs nothing to borrow. In this environment, future money is almost as valuable as current money. Investors are willing to wait. They become patient. They are willing to pay a premium for a company that might be huge in 2030. This is the summer of the economy. The sun is shining, credit is flowing. In this season, growth stocks outperform. The Ferraris can speed on the open road. We saw this clearly from 2010 to 2021. Tech stocks soared because money was free. But then, the season changes. Winter comes, inflation rises, the central bank raises interest rates. Suddenly, money becomes expensive. When you can get a guaranteed 5% return just by keeping your cash in the bank, risky future promises look less attractive. Why risk your money on a tech company that might make a profit in 5 years when you can get paid cash today? In this environment, future cash flow loses its value. Gravity increases. Growth stocks, which rely on the distant future, get crushed. This is when value stocks shine. Investors run for safety. They want companies that make money now. They want assets, factories, and real cash flow. The heavy truck doesn't care about the wind, it keeps moving. So, your strategy as a company of one must be dynamic. You must watch the macro environment. Here is the COO's playbook. Scenario A: the economy is expanding and interest rates are stable or falling. This is risk-on mode. Allocate more capital to growth stocks. Look for disruptors. Look for companies changing the world. The market will reward optimism. Scenario B: the economy is overheating. Inflation is high and interest rates are rising. This is risk-off mode. Rotate your capital into value stocks. Look for companies with low PE ratios, price earnings. Look for companies with strong balance sheets and pricing power. You want companies that sell things people need, not things people want. People can stop buying new iPhones, but they cannot stop buying electricity, food, and toothpaste. Now, does this mean you should sell everything and switch back and forth? No. That is gambling. A wise portfolio has both. It is about the weighting. Maybe in a growth cycle, you are 70% growth, 30% value. When the storm clouds gather, you shift. Maybe you go 50/50ths or even 70% value. There is also a secret third option, the GARP strategy. Growth at a reasonable price. These are rare gems. Companies that are growing faster than the market but are trading at a fair valuation. If you find a company that has the growth of a tech stock but the cash flow of a value stock, you have found the holy grail. Remember, the market moves in cycles. Trees do not grow to the sky and winter does not last forever. Do not fall in love with a stock just because it went up yesterday. Ask yourself, does this stock fit the current economic season? We have talked about buying based on potential growth and buying based on price value, but there is one specific type of value stock that does something magical. It doesn't just hold its value, it pays you a salary. Imagine if your stocks paid your rent. Imagine if they paid for your coffee. This is not a dream. This is mechanical reality. In the next episode, we are going to build your salary system. We will discuss creating a salary system with dividend stocks. We will learn how to turn your portfolio into a passive income generator that pays you while you sleep. Prepare your ledgers. The goal is cash flow. I'll see you in the next video.